Mark, I'm going to make you the presenter. Welcome back to our community, buddy. How are you? Hi, Mark. I can hear your voice.
I'm unmuting him because when they call, now he's self-muted. I unmuted him because when they call through, they need to be unmuted. Now he's self-muted. So Mark, you need to unmute yourself from the panel.
Okay.
There you go. We
How
can
about
hear you
now? Can you hear me now?
Yes, perfect.
Okay.
Perfect.
Mark.
Wonderful.
Welcome.
Happy New Year, Mark. How are you?
Thank you very much. Happy New Year to you and everybody else, Dale. Thanks for having me on today.
Great to have you here. So what's on your radar? What are you showing us right here?
Well, this is a weekly chart of the Bloomberg Dollar Index. So I typically utilize this as opposed to just the DXI just because it has a far lower percentage against the euro. And so
more balanced measurement.
That's right. It's about 30. All of them are high against the euro. This one is about 30 though versus over 63%. So I mean, a lot of them look very similar. Obviously, we've been in a fairly steep, decline since December of 2016.
And so, what do you think? Are we nearing the end of this portion of this dollar decline? Commercials have been. Specs have been huge net longs in euro and everything, and they've been right. It's a great lesson that the small spec and hedge fund could be right, that the commercials have deep pockets and they could be wrong for a long time. But now I'm thinking we're getting pretty close. Looks like you have a 5 coming up here.
Yeah, that's correct. So in this count, I utilize a lot of DeMark as overlays on the underlying price. And so we're at a 5 count, which means potentially we have another 3 to 4 weeks of pullback. It doesn't mean it has to be as extreme as we've seen this week, but it is likely that we go at least a little bit lower before we see an immediate reversal. And I would argue technically just getting down under the lows from last September is still, fairly negative. I have a graph of the sentiment that you mentioned against the the euro, the non-commercial, the spec longs, and it's interesting that you look at the fact that we've just gotten to really new highs. And so if you look at things technically, yes, we are really at highs here, but still, go ahead. But I would argue that this really can continue a bit longer, and so I think it's going to be mid-February that we turn. I don't know that it's going to be imminent, that it has to happen right away. So even if there's a little bounce, I still think there's probably a little bit further to go. And the charts in the euro actually support that. And if you look at things like, the euro against the U.S. dollar, you see that we're still early in the count to really peak out. And so a lot of that still can make the case that, we can move a little bit more to the upside. And so here's a chart. Let me widen this out. Okay.
Yeah, some people were talking 26. I believe that would be about 61.8 back from the whole fall from 140 to 103.
Yeah, I'm looking at not only, see on a daily chart, you can make that case. On a weekly, if you go back just since 2008, where we peaked out in the euro against the dollar, this whole downtrend hits right near 127.
Okay. Interesting.
And really, the counts on a weekly basis are at a 10 and 11 here, along with a DeMark 5 count and a green. So this means that there's likely another 3 weeks of gains in the euro versus the dollar. So I see it going from 124. Any minor pullback here, you'd still be a buyer of euro and think that we get up to 126.5 even. So 126 to 127 is an area. But really sometime in the middle part of February, I think that's a time you want to fight the trend, and really is still a little bit early here.
Anything else setting up for mid-February? We're parabolic in the market. I wanted to ask you, how do you explain the relative weakness between the Russell and all the other averages? And then if you go inside something like the NASDAQ, one of the darlings, Tesla, is not participating, and looks like it could be headed down for a breakdown.
Yeah, the markets obviously have been quite resilient, and so overbought conditions have been a constant concern for anybody that's really looked at equities since the beginning of the year, we're up over 6%. We're really right at an area now where there's a couple different cycles that are coming in that could have importance in the next 3 to 5 trading days.
Interesting.
So I think it actually could be a little bit earlier with regards to when equities peak. And specifically, there are a couple different things that have just started to happen that are a little bit of a concern to me. One is that the transports have started to really show signs of deterioration of late. We've seen the airline pullback. We've seen the move down and the rails. And so this has broken the...
Yeah, and semis got killed too. But yet trannies are, according to Dow, they're the leader, right?
Well, both semiconductors and transportation stocks tend to be leading sectors. And so, as you mentioned, the semiconductors, we have what I think is a false breakout, got right up to right near 1,400 and now have snapped back and have actually violated not only the trend from January, but gotten beneath this area we broke out. So I view this as a short-term negative for both semis and transportation. And really the builders are the other group that are starting to, as of yesterday, showing signs of breaking out. So breaking down.
Could that be oil?
Oil. Well, I don't know. This is just recent that this has happened. These have been, builders and oil have been going up at the same time for the last few months. So it's tough to all of a sudden just pinpoint that on oil.
Okay.
The one thing I would mention is that, Treasury yields continue to rise, but we're close to getting DeMarc sells in Treasury yields, at least on the 10-year. So I think there's going to be one final push up to right near 270 in the 10-year, and then we're going to show signs of peaking out there. And so, as you see, we're right near the former highs from December 16 and also March, which were 265, and we got above really those prior highs, 262, 263. We need one final burst higher in yield, and that would give us some type of a signal there. And what's interesting is that some of the defensive groups have recently started to show real strength. And so that is an area where, that's interesting when you look at things like, and bear with me 1 second. So here's a daily chart of the XLU. So you can see we've broken out of this downtrend from, the middle part of November. It's interesting that the defensive sectors are strengthening.
Yeah, the utilities, right?
That's correct.
Okay.
Utilities, also the REITs. So the REITs are also strengthening, and you've seen telecom also. So Staples started the process last week. We saw signs of Staples bottoming out in relative terms versus the S&P. This week, it's been utilities, it's been telecom, and so I view that as being really interesting, and the fact that consumer staples versus the S&P got right down to prior lows, and we've had a decent bounce off that level. And the defensive stocks have acted far better than what should happen on a big surge in equities.
Yeah, interesting.
So for me,
the VIX is not making new lows, Mark.
Yeah, the VIX has been quite constructive. That's a great point, and I mentioned that in my piece a couple days ago, that the VIX, you see the VIX having bottomed in early January at right under 9, and now it's shot up and it's around 1150. So this is a very constructive pattern, but it's really constricted over the last couple of years. You see that the pattern of declining highs and the lows have been right here, but I think this is setting up for an upcoming breakout to the upside. So I do think there's going to be some above average volatility in the month of February. So I like positioning, really buying vol, buying puts in general, getting long Vega and Gamma, just buying options in general. I think should be the way to play this market versus trying to reach for the S&P at current levels.
Yeah, interesting, because almost everything you brought up says there's a defensive move coming in utilities, and staples are safety, and the Dow's been the leader. They're the blue chips, and more of the spec arenas are beginning to get some pressure, and one more push up in yields, and that'll be it. Do you think if we get a bond rally and yields peak up around where you're looking for, Mark, that we could come back and negate the breakout at 265 and really have people wrong-footed, and that it could be a significant pullback in yields?
Yeah, I am not sure I'd go that far just yet. I think that it's probably going to be a minor pullback. I do have respect for, the weekly move that occurred in Treasury yields. If you pull up a weekly chart, you can see, this is a fairly substantial breakout that we saw from early 2014. So initially, if this gets up to 270, I think we probably pull back to 250, but the move clearly is to the upside. It's a decent breakout. And so the longer term area is right near 3%,
doesn't it? Yeah. Okay. 3%.
Yeah. The longer term on a monthly, if you look back, going way back, that's clearly a longer term. Let me see if I can get the right chart here for that. So yeah, going back since the mid 80s, that's up right near 3%. So we'd have to get above there to think that you have a big surge and really start to materially change things. So getting up above the area that was in early 2014, 305, that would be a big signal that yields likely are going to start a very lengthy intermediate term rise. And I think that's a little bit premature just yet, but we'll wait and see,
Any view on the oil shares? Because here's another case where it proves how deep the pockets of commercials are in the oil market, that they've been short. They have record shorts, even more short than they were at 140. And the market definitely accelerated. So I'm wondering if the oil shares, which have been pretty good performers over the last several months, if they're showing any signs of getting tired.
Well, one thing that's interesting about the energy space is it was obviously one of the worst performers last year. And so right around late August, early September, we saw that start of mean reversion. And, obviously we've had a big move. And really it's been a lot of the integrated and E&P names. It hasn't really been the oil services up until recently. We've just seen that move in Schlumberger and Halliburton and some of the big oil services names, but this is still really early to think that there's a meaningful peak. We did test the former highs and things like F.A.C.E, but you look on a longer term basis and it's really still quite constructive in terms of what's happening on a monthly basis. And, my thinking is you could have an equal wave move potentially of what we've seen there. January, February tend to be very bad months for energy in general, and this has been, it's really defied expectations. So XLE on a weekly basis, going back since 2014, that's a fairly decent breakout that we saw late last year. We're testing these highs, but I can't say with any certainty that, the move is over and that you want to turn down. I think I'd want to see that in crude first, and until you see that, the move certainly is still very much to the upside and crude. So there's really been no evidence of any real deterioration there.
When I was coming in up in the business, there was a traditional February break in commodities. What's your take on gold? Gold corrected a little bit here. The gold shares have been underperforming the bullion itself. Wondering what your view is with what's happening in the miners.
Well, we very well could play catch up in the miners. That's correct. And the miners have underperformed the physical, the commodity a bit. I like gold in general. I think the dollar's decline is not over, and I don't see much more move up in treasury yields in the short run. So I think if 270 is a cap and the dollar keeps going down and yields turn down, and that's going to be bullish for gold. And so we'll finally see, that breakout of what I think is almost an 18-month cup and handle pattern in gold. So if you look at weekly charts of it, it really helps to put this in perspective in terms of where we've come. This is the peak in 2011. So we did break out really last July, August of this longer term downtrend. Since the peak, we've consolidated and now we're testing it again. So this formation for me is pretty constructive. And if you get up above 1370, then we could have a serious move in gold that'll at least get to probably 1550.
Yeah, I agree with you on that. Yeah. So anything else on your radar? You and I think just broke a record for covering the most markets in the shortest amount of time.
Right.
I think we've talked about everything. Anything else that you'd like to bring up? And perhaps you could show your website and your service, Mark, and how people could reach you.
Sure. Yeah. So, I tend to be still bearish on the dollar. I like the euro. I think commodities are in a bottoming process in general. I think that instruments like the DBC are a great way to play the space. You see the CCI index, which effectively has broken out. So I think there's an interesting way to play that. And obviously the liquid ETF DBC will give you exposure to that. And right now it's around $17. It's very liquid. So I think you probably can get up to the low 20s if we have the kind of move, I think. Now the grains obviously are a bit premature.
Boy, are you a mind reader? I was just going to ask you about the eggs. Go ahead.
Yeah, so we haven't, everybody's talking about La Nina and the potential of cooling waters in the Pacific, and it's already affected Argentina, and so I don't know that, eventually I think that's going to happen. It might be postponed until maybe midsummer. I think there's an interesting move that could happen with a particular cycle in coffee that, might produce a decent move. But, the softs have not been as, at least majority of them, sugar and coffee, have still been not doing all that well. And the grains in general, when you look at things like corn, it's just been a tough market to really buy. It's really been the base metals, it's been the energy, and it's been, obviously the precious metals now are starting to show signs of strength there too. So that's I think.
And the Chinese have been stockpiling wheat big time. So, and you're right, La Nina, the impact is usually in the summer, where you don't get enough rain in the Midwest during La Nina years. Yeah.
So it's been an interesting move this week, but in general, I think in equities, go ahead.
Is there anything you don't watch?
Well, I try to cover it all, equities, commodities, currencies, treasuries. I think the yield curve is sort of at an interesting spot that, when you take a look at what's happening, the longer end has been really continuing to flatten out, whereas the 2s, 10s has really been stabilizing a bit. And so for me, that's sort of interesting. And you run longer term monthly DeMark counts on what's happening with treasury yields, and you see that right now, for the first time, we have, let's pull this up so viewers can see this properly. So first of all, on a daily basis, we've been flattening all of last year. With the Fed almost 100% certain to hike in March, it's thought that, we're going to continue to go down to zero. And that might happen, but this pattern is starting to show more signs of stabilization in the short run. And, historically, when we started to see a steepening in the yield curve, it coincided with the prior market pullback in 2007 to 2009, as well as 2000 to 2003. And of course, those are from inverted levels, but it's still interesting when you look at, the signals that are now apparent. Let me see if I can pull up the monthly.
That's a pearl, Mark. So most people are worried about the market when the yield curve is flattening or inverting, but you're saying that the market is in more trouble when the yield curve is expanding.
Well, here's the 2s, 10s curve. So you see what happened from 2000. We actually bottomed out and we steepened dramatically throughout the entire equity market sell-off from 2000 to 2003, and then we pull back. And so there have been pretty decent signals with regards to DeMark, which coincided with the bottom. We have TD sequential buys right at 2006. We started to steepen. We got sells in 09. We got another 9-count sell set up. And then now we are on a combination of both TD sequential and combo buy signals. And they need to be confirmed, of course, before you can really make anything of that. And so it's going to require, that daily chart that I showed earlier to really turn up and for us to really get over almost 72 basis points, which would take out that former high. If that happens, then yield curve would steepen dramatically. And so, that's something
that's counterintuitive because, people that are long financials have been waiting for the yield curve to begin to steepen so that banks could make more money. But you're saying that as it steepens, the market may become more vulnerable rather than as it flattens.
That's exactly right. Who knows how many times they're gonna hike this year? It's tough to say. I think if the equity market does not sell off materially in February, then we probably will get some evidence of we'll see a hike in March, and maybe that causes the final washout in this before we start to steepen. I've just been watching the daily chart of the yield curve, and I think it's interesting because it's certainly setting up like something different is brewing than what people are suggesting.
Yeah, what a great overview, Mark. I'm so glad that you agreed to come back and, give me your thoughts going into 2018. What's the best way besides @Mark Newton on Twitter for people to follow your great work? And
so I have a website that I run, and I do consultancy with a lot of institutions. I provide technical analysis for both institutions and retail, and so people can sign up and get a free trial to my site. I provide daily and weekly commentary, as well as usually a 5-minute video every morning that covers all different types of markets, and then we do conference calls every Thursday afternoon at 1 o'clock, just like this here. So I'd invite everybody to come to newtonadvisor.com, or you can email me at info@newtonadvisor.com, and I'd be happy to add you to the list for a trial, or send you some of my reports, or figure out a way that we can do some business.
Yeah, listen, Mark is a must follow on Twitter, and I would encourage people to try his trial. At the minimum, you'll get hooked, because I'm hooked, and I need to talk to you every quarter, Mark, and I appreciate and appreciate you always being willing to come on and edify our community. I hope this is a great year for you, buddy, in every way, not just trading, but in every way.
Well, thank you, sir. It's always a pleasure, Dale. It's great to be on, and I'm looking forward to coming on again soon. So thanks for having me.
Yeah, thanks so much for all the crystallizing of some things I was thinking about, and opening my eyes to things I hadn't considered. And you know what I call you, Mark, like it or not, you're my trading warrior brother.
Likewise, you as well.
All right, buddy.
Well, a big fist bump for 2018, and let's all make some money. A safe, happy, and prosperous 2018 to everybody.
Thank you so much, Mark. That's it for our week. Everyone have a great weekend. Luca, everyone, remember, most of all, don't just count your pips, count your blessings, and go to FX Street on your Google account and vote for ForexAnalytix as best new contributor. And enjoy your weekend, and I'll see everyone on Monday. Adios. Thank you, Mark.